Good morning, dear students. I welcome you all to this revisionary session on the topic of mutual fund pertaining to CA Final Paper 2, which is Advanced Financial Management. In the previous class, we have discussed about the topic of portfolio management. Now, in this session, we'll be taking the topic which comes next to that, which is mutual funds. Now, mutual funds are essentially one of the most prominent tools for investment in the modern era. And we find that a lot of promotions are also happening around the same thing. Okay. So when we look at this topic of mutual funds, we do have a look at various types of mutual funds, which is like open-ended, closed-ended, equity, debt, hybrid. So those all things I'm not going into details about it. And neither I'm going to look for the structure also, because we are very well aware of what is the structure of a mutual fund is. So basically the structure of mutual fund is starting with the sponsor, then you have the custodian, then you have the fund manager, the AMC, transfer agent. So all those things are quite intuitive enough to be understood. Now, what's really the thing that we're going to revise today is by looking at few practical questions. Okay. We know how do we calculate NAV. We know how to calculate the performance ratios, which is Sharpe ratio, trainer ratio, Jensen's alpha. So all those things are definitely taken care of. Uh, what we are going to do in today's session is we'll be solving three really interesting questions in which we'll be trying to revise the chapter of mutual funds. So let's straight away go ahead with the topic of mutual funds with the first question. Okay. So just go through this question, guys. I'll just give you a couple of minutes to read this question carefully. Read this question carefully, guys. So an investor wishes to invest 15 lakh in the dividend plan and bonus plan. So we are having two plans. One is a dividend plan, another is a bonus plan. of the same mutual fund in the ratio of 70 is to 30 on 1st April 2026. The following information is available. We have initial NAV for both plans as 40, entry load is 1.5, exit load is 0.75%. Investment period is from 1st April 2026 till 31st March 2027. You have to ignore taxation. Okay, so the investment period is for 1 year. We know the entry load, we know the exit load. Now, investment period is given, taxation is to be known. Now, what's happening in the dividend plan? In the dividend plan, on 30th September 2026, the fund declared a dividend of 4 rupees per share. NAV immediately before the dividend declaration was 47, and after the dividend declaration, NAV, of course, it reduces to 43. Entire dividend is automatically reinvested at 43 per share or per unit, and closing NAV is 46. Then in the bonus plan, it announces a bonus of 1:5. Before bonus, the NAV was 50, and after bonus, the NAV is 41.67. Closing NAV is 48. Okay. Now, we have to compute the number of units initially purchased. First, we need to get the number of units that were purchased. Second is compute the additional units received through dividend reinvestment under dividend plan and bonus issue under the bonus plan. So you have to get the number of additional units received. And then we have to calculate the redemption value of each investment after deducting the exit load. And we have to calculate the total return and holding period return. Advise the investor which plan provides the higher effective return, giving suitable reasons. Okay. So let's get started with it one by one. First thing is to calculate the number of units initially purchased. The investment that was made is in the ratio of 70 is to 30. So of course, we need to first have the information of investments made. So investment in dividend plan. Investment in dividend plan, it is going to be 70% of 15 lakhs. So since it is 70% of 15 lakh, the investment that you're making in dividend plan is 10 lakh 50,000. That's 10 lakh 50,000. And the investment that we're making in the bonus plan, investment that is being made in the bonus plan is 30% of 15 lakhs. So 30% of 15 lakhs is going to be rupees 4 lakh 50,000. Okay. So that's the investment made, and then we have the number of units purchased. So to get the number of units purchased, we'll have to look at something called as the entry load. So entry load is 1.5%, right? And exit load is 0.75% on the redemption value. Okay. So this entry load will be, of course, on the NAV thing. So initial NAV is 40. So we'll say issue price. So the issue price will be 40 into 1.015 because there's a entry load of 1.5%. So the issue price is 40.6. So units acquired under, so the number of units, the units that we have acquired under bonus plan. How much units did we get under the bonus plan? Units acquired under bonus plan. What will be the number of units that we're getting under bonus plan? That's simply 10,50,000 divided by 40.6. Right, so 10,50,000 divided by 40.6. So how much is this number? Yeah, 25,000. This is 25,862.07. Let's keep the decimals up to two levels. Okay. Then what will be the units acquired under? Sorry, this was under dividend plan, right? This was under dividend plan. Now, of course, we want to know what is the units that we are acquiring under bonus plan. So under bonus plan, it is 4,50,000 divided by 40.6. The units that we have is 11,083. 11,083 point something, 0.74. Okay. So these are the units that we get. Now the second thing that we have is, that's the number of units. Then we have to compute the additional units that we have purchased, that additional units that we receive under dividend reinvestment and bonus plan. So the units are, the dividend is going to be reinvested at 43. So let us compute the additional units. Additional units under dividend plan. So additional units under dividend plan. First up, I need to get the amount of dividend. So the dividend amount, we are going to divide it by NAV. So the dividend amount will be 25,862.07 units into, what is the amount of dividend paid? The amount of dividend that was paid is 4 per unit. So into 4 divided by, at what NAV is it going to be reinvested? It's going to be reinvested at the rate of, because NAV after dividend declaration is now 43. And entire dividend is reinvested at 43 per unit. So this is going to be divided by 43. Right. So what is the additional units that we are getting? What's the amount of additional units that we're getting? 2,405.77. Okay. So 2,405.77. Okay. Then what's the total units? Total units under dividend plan. Total units that we have under dividend plan is 25862.07 plus 2,405.77. So total it is 28,000. 28,267 0.84, right? That's your units under total units under dividend you plan. Same way, can you tell me what are the additional units under bonus plan? Additional units under bonus plan, because in bonus plan, uh, the bonus is in the ratio of one additional security for every five securities. So units that we have acquired is 11,083.7. Okay, so 11,083.7. Under bonus plan, this will be like 11,083.7 divided by 5. So what will be the additional units that we are receiving under bonus plan? 2,216.75. Okay, 2,216.75. And then what will be the total units? Total units under bonus plan. That will be 11,083.7. Just 0.7, right? 0.74 plus 2,216.75. So total is 13,300.49. Okay, these are the total units that we have under both the plans. Okay, then we have to get the redemption value of each investment after deducting the exit load. So after deducting the exit load, whatever is the redemption value, that is what we need to compute. Redemption value of each investment under after deducting the exit load. So let us compute the redemption value. Now remember, there is a exit load applicable. So I need to take that into account. So we are going to compute the redemption value, but of course, redemption value of each unit under dividend plan. So under dividend plan, what will be the redemption value? Because when we are redeeming, the closing NAV is 46. So since it is 46 and we have an exit load of 0.75%, right? So whatever is the amount of NAV, from that we need to subtract 0.75%. So what is the redemption value? 45.46 minus 0.75%. How much is this? This is 46 minus 0.75%. 46 minus 0.75%. Of something. 1 minus 0.0075. 1 minus into 46. That's 45.65. 45.66. Let's take it because it goes as 666. So 45.66, that's the redemption value of each unit. And what's the redemption value of all units under dividend plan? So under dividend plan, what's going to be the value? That's 45.66 into number of units that we have, total units, that is 28,267.84. So 45.66 multiplied by 28,267.84. So what's the total redemption value? 45.66 into 28,267.84. And this is 12,90,709.57. Okay. Or you can say 710. Same way, we have to get the redemption value of bonus plan. So can you tell me of the bonus plan, what is the total redemption value? Like over here, we got the total redemption value as 12,90,000. Same way, compute for the bonus plan, everyone. Give me the number for bonus plan. Give me the number of bonus plan. What is the bonus plan redemption value? Just calculate and give it to me. Because the closing value is 48. The first 48 minus 0.75%. This multiplied by 13,300.49. So just check if you're getting this as 6,33,635.34. 6,33,635.34. Getting it? Some decimal here and there. That's absolutely fine. Then we have to calculate the total return and the holding period return. So holding period return of dividend plan. We'll simply say we are realizing 12,90,709.57 against an investment of 10,50,000. Is divided by 10,50,000. So what's the holding period return percentage? What is this percentage return? 22.92%. Okay. Same way, what's the holding period return for the bonus plan? That will be 6,33,635.34 minus 4,50,000 divided by 4,50,000. What is this number? 40.81%. Okay. Now, it's quite evident that bonus plan is definitely proving out to be a better plan over here, because which is obviously a higher number as compared to the dividend reinvestment plan. So total return and holding period return is just one and the same thing over here. Total return will be in terms of rupee. So whatever is the numerator part, that's the total return in INR. And the percentage is your holding period return. Which plan provides a higher effective return given the suitable reasons? Of course, bonus plan is providing you the higher returns. Okay, in terms of rupee terms, of course, you can see this plan is better. But in terms of percentage, the bonus plan is a better proposition. Okay, let us go for the second question now. Just go through this second question is just a couple of minutes for you to look at this question number 2. Okay, let's have a look. The following data relate to the recent performance of a closed-ended mutual fund. Now, what is a closed-ended mutual fund, guys? What do you mean by closed-ended mutual fund? Yeah, tell me. What do you mean by closed-ended mutual fund? Anyone? What's a closed-ended mutual fund? And how is it different from open-ended mutual fund? Yes. So in case of closed-ended mutual fund, the units are issued once for all. The mutual fund doesn't issue any additional units, and it doesn't go for redemption of any units also. So these units are basically listed in the market. So in closed-ended mutual fund, the mutual fund doesn't issue any additional units, nor does it carry out any redemption of units. So all this buying and selling of units happen in the open market. Okay, so that's what we see that over the 4-year period, we have different NAVs over here, and these NAVs are having certain amount of premium or discount. Okay, so of course you would have purchased the units at some premium amount or at some discounted amount. Okay, because you're not going to buy these at NAV from the mutual fund, because mutual fund is not allowing you any sort of redemption, right? It's not allowing for any sum of redemption, neither it is looking for any issue of any additional units. So in either cases, Hmm. So NAV, we say 25, these are all numbers that are given, these are the NAVs. And these numbers are your premium or discount. Why are they given? Because I need to compute the market value. Because since this is a closed-ended fund, there is no redemption, there is no issue that is going to happen from the mutual fund end. Because once the mutual fund issues the units, it stops for it. And whatever trading happens, that happens in the open market. Okay. Now, a negative percentage indicates that the fund is trading at a discount to NAV, whereas a positive percentage indicates that it's trading at a premium. An investor purchased 1,500 units of a closed-ended fund at the beginning of the period zero, that is at a market price prevailing at that time. So you purchase 1,500 units at the beginning of the period zero at a market price prevailing at that time and sold all units at the end of period four at a market price prevailing then. So you have purchasing in time period zero. Over here you have bought and here you are going to sell. Ignore brokerage taxes and transaction costs. Determine the market price of the fund at the beginning and at the end of each period. Calculate the average return per period using a geometric mean earned by investor based on market prices. Then compute the geometric growth rate of NAV and compare the investor's geometric return with the geometric growth rate in NAV and explain the impact of changes in premium or discount on the investor's return. So it's quite a manipulative question to start with. So let us begin first. You have to get the market price at the beginning of each period. So for each of these periods, I need to get the market price. Okay. So the NAV and premium or discount given to us. So period NAV, and then you have the premium or discount percentage. So you have period 0, 1, 2, 3, 4. NAV is 25, 27.2, 28.4, 26.4, 28.1. Premium is 0. This is minus 6%, this 3.5%, minus 2.5 and 5. So we need to first get the market price. So market price will be first 0th year, it's going to be same 25. But of course, then subsequent numbers are going to be computed as 27.2 into 1 minus 0.06. Next, it's going to be 28.4 into 1 plus 0.035. Then 26.4 into 1 minus 0.025 and 28.1 into 1 minus 1 plus 0.05. Okay, give me this market prices, everyone. Give me the market price of the shares, market price of units. Yeah, tell me what are these market prices? So first one, it is 25.568. Second is 25.668. Okay, third one 25.74, and fourth year market price is 29.505. Okay, these are the market prices. Now I'll have to go for the next part of the question, which says calculate the average return per period using the geometric mean earned by the investor based on the market prices. So we have to get the return that you're earning in each of the time period. So we'll say year. Okay. You have the opening market price You'll have the closing market price. And then we compute the return. So in year one, your opening market price was 25. Closing market price is 25.568. Okay. So the return that we have, NAV for the, what you're saying, year two is 24.8. One second. Okay. So this is 24.8. This is also 24.8. But I think, okay, this is accurate. Fine. So the return that you're earning, opening value 25, closing value 25.568. So what's the return that you're getting in the first year? 25.568 minus 25 divided by 25 into 100. That's 2.272%. 2.272%, right? Okay. Same way, we have to look for the year 2, year 3, and year 4. Opening value is 25.568. Closing value is 25.668. Here opening value is 25.668. Closing value is 25.740. Opening value is 25.740 and 29.505. Okay. Calculate the returns now, guys. Calculate the returns for year 2, year 3, and year 4. Yep. So in year 2, the return is 0.391%. Then the third year it is 0.281%. And then it is 14.628%. Just check if you're getting these numbers, because I've maintained a uniformity of 3 decimal places. We're getting these numbers? Okay. So that's the return which we got. Average return per period earned by the investor, now based on geometric mean return, they're saying. So how do we calculate a geometric mean return? Do you know how to calculate the geometric mean? How do you compute geometric mean, by the way, guys? Geometric mean. So let's say if I give you 4 numbers, A, B, C, D, or let's say I'm giving you actual numbers, let's say 4, 6, 9, 12. How do you calculate geometric mean of this? Yeah, what's the formula? What's the rule for calculating the geometric mean? Can I just add all of them and divide by 4? Adding and then divide by 4, it's going to give you the same geometric mean return? No. Then how do you compute the geometric mean? Hmm? Well, geometric mean is actually calculated as 4 into 6 into 9 into 12, the whole raised to 1 by 4, right? Geometric mean is multiplying all of them and then taking that particular root. If it's four numbers, then you have to take the fourth root. If it's five numbers, you have to take fifth root. If it is two numbers, you have to take this square root. Okay, got it? So when it comes to geometric mean returns, it's going to be calculated as 1 plus return for the first period into 1 plus return for the second period into 1 plus return for the third period into 1 plus return for the fourth period, and then this entire thing will be raised to 1 by 4. Geometric mean, you cannot have just the multiplication of all the returns for a simple reason. What if you have certain negative numbers? It's quite possible that square root of that is not possible. In fact, what we say is like 1 rupee grows by the first year return, it becomes this much. It again grows to this, it again grows to this, and it again goes to this. So the rupee or the money keeps on growing, and then you take the fourth root of that, right? So I just apply simply the formula. It is 1 plus, or I can call it as 1.02272 into 1.00391. Then it is 1.00281 into 1.14628. This entire thing raised to 1 by 4 is going to be the geometric mean of returns. Okay, calculate the geometric mean return, guys. Get the geometric mean returns. Just multiply it and take the fourth root. That will provide you the geometric mean of returns. How much is it? Just multiply these four numbers and then press the square root button twice. That's 1.042294. Okay. So इसमें से we are going to subtract -1 because this is the value of 1 rupee, or average value of 1 rupee after a year. So when I subtract this, answer comes out to be 4.2294%. So geometric mean return is it's going to be 4.2294%. Okay, got it? Yeah. So this particular term is going to tell you average value of rupee 1 in 1 year. So of course, the rate of return will be after subtracting 1. Okay. Then the next thing is they're saying compute the geometric mean or geometric growth rate of NAV over the same period. Now, same way we have to get the numbers for NAV. So So this is NAV, or I can say this is your opening NAV, and we need the closing NAV. So closing is 27.2, 24.8, 26.4, and 28.1. So we have here 1, 2, 3, 4. We have to first get the returns like we did in the previous case. And then we have to get the geometric mean of returns. Can we calculate it? Just as we did in the previous case, calculating individual returns first and then taking the geometric mean. Can we get the geometric mean, guys? Can we replicate it? Yes. Ankit, Umang, Hariharan. Yep. Calculate the geometric mean of returns. So first you need to get the returns for individual cases and then take the geometric mean of it. So just help me with these numbers. What are the returns of individual year when it comes to NAV? This is what? 8.8%. Okay. Then you have what? Negative 8.823%. And you have positive 6.45% and 6.439%. Okay. Geometric mean return will be 1.088 into 1 minus 8.823%. That's 0.9117, 1.0645, 1.06439, and then this entire thing raised to 1 by 4 and then minus 1. So calculate this number, product, take the fourth root and then subtract 1. Yeah, how much is it? 2.97%. 2.97%, that's the geometric mean of returns as far as NAV is concerned. And here it was as per the market price are concerned. So what we observe over here is that from the market price, if you would have invested, you're earning 4.23. And as far as the NAV is concerned, the overall geometric mean average return is 2.97%. Now the question asks us to compute the geometric mean, compare the investor's geometric return with geometric growth rate in NAV, and explain the impact of changes in the premium or discount on the investor return. See, the investor return is 4.2294, which is more than 2.97%. Can I say extra return which investor gets due to market premium or discount? It will be simple. 4.23% minus 2.97%. So the extra return which the investors are getting 1.26%. So extra return which you are getting as an investor is 1.26% due to the premium or discount that's happening in the market. Okay, that's pretty simple. Now, let's go for the last question for this topic of mutual fund. It's a very interesting question. Question number 3, guys. I'll just give you a couple of minutes. Quickly go through the question. Okay, so on 1st Jan 2026, open-ended equity fund had 750 lakh units. So it had 750 lakh units outstanding with a NAV of 32 per unit. So as of now, the NAV per unit is 32. During the quarter from Jan to March, the following transactions took place. Now the transactions that we have is 10 lakh units were issued at an opening NAV plus an entry load of 2%. So you issued 10 lakh units uh, at an opening NAV plus an entry load of 2%, which is adjusted for dividend equalization at the end of January. Then 8 lakh units is repurchased at an opening NAV less an exit load of 1%, which is adjusted for again dividend equalization at the end of February. On 31st March, the trustees declared a dividend of 65% of distributable income. And you have the dividend and income which you have received in Jan, Feb, and March. First up, what is this dividend equalization, everyone? What is this dividend equalization part over here? Because that's the very crucial part over here, or that's the only thing which is going to be stopping you from solving this question. So let's understand what is this dividend equalization. What this dividend equalization is? Yeah, dividend equalization means new units are issued using dividend income. No, no, not like that. What is the dividend equalization? Ankit, Hariharan, what do you mean by the term dividend equalization here? Well, Let us try to understand what is this dividend equalization with the help of certain numbers and maybe by way of charts. A timeline view. So this is representing the month of January. Let's say this time period is representing the month of February, and this is representing the month of March. So as far as units are concerned, in January opening you had 750 lakh units. Then by the end of January, you issued 750 plus 10, so total 760 units. And then 8 lakh units were repurchased at the end of February. So this is going to be like 760 minus 8. So by the end of February, you have 752 units. So by the end of March, you're having 752 units. Now, whatever income is being generated in the month of January, income that is being generated in month of January is 54.375. Then you have this as 61.25, and in March it is 69.875. So this 54.375 income in the month of January, 54.375. This income belongs to which unit holders, guys? This particular income belongs to which unit holders? Can I say this purely belongs to 750 units? This particular income is purely belonging to this 750 units. Okay. But when this income is going to be distributed over here, that will be distributed amongst all the unit holders. So the new unit holders which are going to come, with the 10 unit holders which are going to come at the end of January, can I say they will be actually also getting the ownership of this accrued income? They'll be also getting the accrued income thing over here. So to these unit holders, we are going to simply say that this is the accrued income which we have, and you need to pay for it, right? Because when the units are trading over here, right? So for example, if you have uh, NAV, if it is X over here it is going to be X plus 54.375 divided by 750, because this income is also accruing to this, right? So when an investor is coming by the end of January, he is actually not entitled to any of the income. But when the income will be distributed later on, he'll be getting a share of it. So, of course, these investors, the new investors which are coming, we are going to tell them, the new investors which are coming over here, we are going to tell them that 54.375 units. We're going to say that 54.375, the amount of income is actually belonging to 750. Is actually belonging to the 750 unit holders. Okay. So this is actually belonging to the 750 unit holders. Now you are coming as a new investor. You should be actually paying for this 54.375. You should be paying for 54.375. And the money which you are going to pay additional is what we call as dividend equalization. Right? So the new investors new unit holders जो कि whichever is the 10 need to pay for accrued dividend. Okay, this is simply like something like ex dividend and cum dividend. Okay, do you know what is ex dividend, cum dividend, everyone? You're aware of what is ex dividend, cum dividend? I think you might have learned about this in investment accounting. Investment accounting in say enter. So ex dividend, cum dividend. I hope you are aware of it. Right. So ex dividend is without dividend income, while ex dividend NAV is NAV without. So one side you have NAV without accrued dividend, and the other side you have NAV with accrued dividend. So when an investor is entering over here, we are going to obviously say you need to pay for the accrued dividend, right? So that's your cum dividend NAV. Same way, if an investor is taking an exit, so this 8 unit holders which are taking an exit in February, are they entitled to any amount of dividend income? Of course, yes. They are entitled to both of these units. Right? So I can say, in fact, this 61.250 belongs to this. Then the 69.875 belongs to this. Okay, so these are the unit holders which are supposed to be uh, owning that particular income or dividend. So when a new investor is coming in, he or she will have to pay for that accrued dividend, because going ahead in future, when the company distributes the dividends, these unit holders are going to get that dividend also. So of course they can't get it for free because they have not invested for that time period. So they need to pay for it. So initially you pay the dividend equalization part, and later on you'll get the full amount of the dividend. Okay. Are we clear what is dividend equalization over here? Are we clear what is dividend equalization, everyone? Yes. Okay. So as a unit holder, when you are investing, you are going to pay for the NAV, you're going to pay for the dividend equalization, and you also need to pay for the entry load, right? So investor buying units will pay for investor buying units will pay for NAV, dividend equalization, and also entry load. So basically, price over that time will be NAV plus the entry load, and also the investor who is going to sell units is going to get what value? Will get NAV plus the uh, or in fact I can say you're going to get the plus the dividend equalization and minus exit load. Okay, so every time this is what we need to be careful of, that what we are going to pay and what you are going to receive. Okay. So now let's look at, first of we need to compute the income which is available for distribution. So we need to calculate the amount of income which is available for distribution. Let us do the calculation. So this is question number 3. I think we have discussed that. Yeah. Question 3. We will say income available for distribution. Dividend equalization, why added in case of, because dividend equalization we need to be paid to you, right? When you're selling the units, there is an income which has accrued on the shares, on the units. So you need to compensate your investor with that, right? So for example, the investor who's taking an exit over here, he has already invested for 2 months. So he is definitely entitled to both these dividends. Got it? So he should be getting the dividend or income which is earned by the mutual fund during his period of investment. So we need to be paid for that. So he'll be paid NAV, he'll be paid dividend equalization, and of course, exit load will be subtracted. Okay. Let's go for calculation of income available for distribution. So calculation of income available for distribution. Calculation of income which is available for distribution. So we'll see this as amount in units. So we have opening units as what? 750. Okay. And then of course per unit we देखेंगे हम. Now, opening units is 750, and then we'll say income of Jan. Income of January. Amount is 54.375. Tell me, this 54.375 is going to be distributed amongst how many unit holders? 54.375 is going to be distributed among how many shareholders? How many unit holders? Sorry, 750. So per unit, how much is the dividend that has accrued? 54.375 divided by 750, which is 0.0725. This is the income which has accrued per unit of the mutual fund as far as the January income is concerned. Then, of course, to that, we are going to add dividend equalization. Dividend equalization. So income of January is 54 point. Dividend equalization to be recovered from new investors. So how many unit holders do we have? New unit holders. So new unit holders are 10. So per unit wise, how much are we going to charge? We will definitely say, sir, it is 0.0725, which is already accrued. So you need to pay for this. So 0.0725 multiply by 10, that gives us 0.725. This is the money that we are going to recover from the new investors. So now the total that we have is how much? 54.375 plus 0.725, 55.1. This total money which is accumulated 55.1. Can you tell me this belongs to how many unit holders? This belongs to how many unit holders? 760. Right? And per unit wise, of course, it is 0.0725. So amount is 55.1, units is 760. So per unit is 0.0725. Then to that, we are going to add now income of February. Income of February is 61.250. Now this 61.250 belongs to how many unit holders? This 61.250, it belongs to how many unit holders? 760 exactly. So the new income which we have for the month of February, that's 61.250 divided by 760, 0.0806. Okay, this is the per unit value. So now the total money which is accumulated 0.250, that's 116.35, and this belongs to 760 unit holders. So on a per unit basis, we have an accumulated value of 0.1531. Right, so this 1531 is going to be distributed among 760 unit holders. But then there is redemption which is happening of 8 lakh units. So this 8 lakh units dividend equalization part, should I add or should I subtract? Because redemption is happening. So we are going to pay out this dividend equalization, right? So we are going to subtract less dividend equalization paid to redeemed units. So we are redeeming 8 lakh units. And how much are we going to pay them on a per unit basis? How much are we going to pay them per unit basis? Of course, the same 0.1531 which was accumulated. The total payment that we'll have is 8 into 0.1531, which is 1.2248. And this is what we are going to pay. And after that, we are left out with 116.35 minus 1.2248, which is 115.1252. 115.1252, that's the dividend equalization paid to redeemed units. And then we have 760 minus 8, which is 752. And then we have this as a per unit basis as 0.1531. Okay, that's the income of February. Now to that we are going to add income of March. Now income of March is 69.875. This income of March is accruing to how many unit holders? 69.875. This accrues to 752 unit holders. And per unit is still 0.1531. No, per unit will change, right? So per unit now it is 69.875 divided by 752. So per unit it is 0.0929. So you add them, we have 115.1252 plus 69.875. Total income which is available is 185 point, okay, 185 point triple zero two against the 752 units. So per unit basis you have 0.1531 or 0.0929, which is 0.246. So that's your income of the month of March. So total accrued income which we have is 0.246. But then against that, what has happened is 65% of distributor income is distributed. So we'll subtract from this minus dividend distributed. 65% is distributed. So how much money is being distributed as dividend now? What is the amount that's distributed as dividend? 185.0002 into 65% of 85.0002 into 65%, which is 120.2501. This is distributed against, amongst the 752 unit holders. So per unit wise, it comes out to be 0.159. So what is the balance left, or balance units which are left? 185.0002 minus 120.2501. This is 64.7501 amongst 752 unit holders, and per unit wise it is 0.246 minus 0.159, which is 0.087. Okay, this is what is left out as a balance now. 64.7501 divided by 752.0861. 0.246 minus 0.159. 1087. Okay, some things over here and there, that's fine. Rounding up thing. Okay, so we're done with the income available for distribution part. Now next is calculate the issue price at the end of January. So issue price at the end of January. Issue price of units at the end of January. So the issue price that we have at the end of January issue price of units, they're saying the issue price is measured opening NAV plus an entry load of 2%. We have an opening NAV. Opening NAV is of course going to be the same, 32, at an entry load of 2%. So this is going to be opening NAV plus entry load plus dividend equalization. Now the opening NAV is 32. On that, we have an entry load of 2%. So this plus 32 into 2% plus. What will be the amount of dividend equalization? Amount of dividend equalization. The amount of dividend equalization for the month of January, it's 0.0725. Yes, 0.0725. Just add them. 32 into 2% plus 32 plus 0.0725. That's 32.7125. Yes, 32 into 2% plus 32 plus 0.0725. Yeah, 32.7125. Dividend equalization is this number. See, in the month of Jan, we have computed the per unit value, right? All right, Oma. That's 0.0725. Got it? Okay. So the issue price is 32.7125. So this is also done. Now the second thing is done. The third is determine the repurchase price at the end of February. Repurchase price of units at the end of February. So what's the repurchase price of units at the end of February? Formula will be opening NAV minus exit load plus dividend equalization. Okay, so opening NAV is what? 32 minus what's the exit load percentage? Exit load is 1%. So that's minus 32 into 1% plus the dividend equalization. What will be the dividend equalization in February? What will be the amount of dividend equalization in February? That's 0.1531. Yeah. So what's the repurchase price of units? Repurchase price of units 31.8331. Okay. So issue price of units at the end of Jan and February is done. This is done. Now compute the distribution per unit. Okay, distribution per unit is anyways calculated over here, 0.159. So that is already done. Compute the closing NAV per unit as on 31st March after distribution. Closing NAV. So closing NAV, for that, we will simply say, what's the opening NAV we had? 32. Right? And then we also have the portfolio appreciation. So we'll say opening portfolio value. Opening portfolio value is, we have 32 NAV and there are 750 lakh units. So it's going to be 750 lakhs into 32. So opening portfolio value is how much? 750 into 32, which is what? 24,000. Okay, opening portfolio value is 24,000 plus we have the appreciation, or we say it's going to be added with the portfolio appreciation. Now, portfolio appreciation is given as 69.875. No, 975.625. To that, I'm going to add now the cash balance. And this will give us the closing portfolio value. Okay, try to compute the cash balance, guys. Compute the cash balance which is left out with us. Compute the cash balance which you have at the end. Try to calculate the cash balance. Yep. How do you calculate the cash balance over here? Cash balance is what? 752 into 32. Hmm. One second. 750. No. Cash balance, you'll have to actually compute it properly. I'll just create a note for this. I'll just give you the idea how to calculate it. So you have opening cash balance, which has not been specified anything. So we'll say 0. Add to it dividend received, subtract dividend distributed, again add units issued and less units redeemed. And this is going to be your closing cash balance. Okay, so use this layout or use this format to calculate the closing cash balance. This Yes. Do you know the amount? I mean, this dividend received is for Jan, Feb, and March. Dividend distributed is already known to us, which is what, 120.2501. The units issued will be the issue price into number of units. Same way, units redeemed will be the redemption value into number of units. Yes. So what's the total dividend that you have received? Dividend that you have received will be 54.375 plus 61.250, and again plus March it is 69.875. So the total dividend that you would have received, total income that you have received, how much is it total? 54.375 plus 61.250 plus 69.875. Total is, yeah, 185.5. Fine. Then the units that you have issued, the issue price is given to us as 32.7125. This is 32.7125. Okay. And how many units have been issued? What is the number of units that we have issued? 10. So for each unit, you are charging 32.7125. You just need to multiply it by 10. 32.7125 into 10, which is 327.125. And the units that you have redeemed, uh, the redemption price is 31.8331 into what is the units that we are actually redeeming? That's 8 lakh into 8. So 31.8331 into 8, that's 254.665. Okay, so just add them all. 185.5 minus 120.2501 plus 327.125 minus 254.665. So that's 137.7099. That's the closing cash balance. So we have the closing cash balance as 137.7099. Why don't we consider the cash amount received or given back as dividend equalization to arrive at closing cash balance? Because that's not the only cash which you're receiving and paying, right? Because you would have obviously received cash when the units are issued, and you would have obviously paid out cash when the units are redeemed. So I need to consider those cash flows also, right? So when you're considering only these two, you're just saying the income which is left with you to be, which is not yet distributed in the form of cash. But your cash balance is going to be affected by these two also. The units which you are issuing, for that you will be receiving cash. The units which you would have redeemed, for which you would have paid the cash. So all the cash movements are happening from the units also. So I need to consider that part also, right? Got it? Yeah. Okay. So 137.709. So what's the closing portfolio value now? Add them all. So 24,000 plus 975.625 plus 137.7099, which is 25,113.3349. Okay, that's the closing portfolio value. What is the closing number of units? The closing number of units. Can I say it was 750? You issued 10 units and you redeemed 8 units. So you have 752. Then you get the closing NAV. 25,113.3349 divided by 752. So closing NAV is 33.3954. Yes, this is the final answer. So I think we have answered all of them. Calculate the total net assets of the scheme. Now, total net assets is definitely this total portfolio value. And after dividing it by the number of units, you get the closing NAV. Are you good with this, everyone? Did we get this solution quickly? Quite an elaborate question to discuss about, because it involves first up knowing how the income is done, what is the income accumulating, then calculating the dividend equalization. And another crucial part was to calculate the cash balance. Okay, so cash balance is something, which needs to be also taken into account while computing the NAV. And that needs to be done by preparing a cash account, or maybe just by looking at what is the amount of receipt and payment. Okay. Okay, so we are done with this mutual fund. All the three questions are done. Uh, so we have seen how to compute NAV, how to compute the rate of return, geometric return, then computing the uh, NAV using the dividend equalization concept also. Right. So with that, we are through with the mutual fund revision. Now let's take a break, and after the break, we will be starting with the revision for uh, securities valuation. Okay. So let's take a break, and after break, we'll start with securities valuation, guys. Okay, I will back everyone. Yeah, I will there. Hello everyone. Yes, okay. So let us go for the next topic now, which is security valuation. So we're going to discuss this topic of security valuation. Of course, the assignment is possibly shared with you. Okay, but initially we would like to first discuss about there are two aspects to this, by the way. One is the bond market, and another is the um, what you say as a equity market or equity shares. So bond valuation and equity valuation. So initially, I'll take up the bond valuation part, and, and then we will go for the equity valuation concepts. So when it comes to bond valuation and bond risk measurement, there are certain terms which we need to know, and also we should be able to calculate. So first up, we know value of bond. Value of bond is simply going to be present value of all future cash flows, uh, which is discounted at YTM. YTM is the yield to maturity, and this is also what we call as a required return. This is the present value of all future cash flows discounted at YTM, which is the required return. Okay. Okay. So present value of all future cash flows discounted at the YTM. So suppose if I give you certain values like face value, face value is 1000, coupon rate is 8%, which is of course 80 rupees. Term secure the term of or the tenure of this bond is, let's say, 4 years. Okay, so face value is 1000, coupon is 80, and term is, let's say, 4 years. And then I say that YTM of the bond is 9%. So I need to get the value of this bond. So value of the bond, is going to be equal to coupon, which is 80, into present value annuity factor at 9% for 4 years, plus the redemption value, which is 1000. You multiply this by the present value factor at 9% for 4 years. Yeah. So what's the value of the bond? Can you calculate this number? Get the present value annuity factor 9% for 4 years. 1 divided by 1.09. 1, 2, 3, 4. We have the present value annuity factor as is 18 to 3.2397 plus 1 divided by 1.09. 1000 into 0.7084. is 80 into 3.2397, which is 259.176 plus 708.4. So the value of the bond is 259.176 plus 708.4, which is 967.60 or 967.58. Okay, so that's the value of the bond. Now, 967, sorry. Okay, that's simply the value of the bond, which is simply taking the present value of all future cash flows. Now, it can be also the other way around. So, other way around, it could be like I'm giving you face value, let's say 100. Coupon is 5%. Term is 10 years. And value of the bond is 107. Can you calculate the YTM? Can you calculate the YTM here? Do we know how to calculate the YTM in this case? Do you know how to calculate the YTM over here? How do we get the YTM in this case? Or yield to maturity? How do we get that yield to maturity? Yep. How do we calculate the yield to maturity is in this case? We use the IRR method, right? So we use the IRR method. First, you give me value of bond at YTM of let's say 10%. Calculate the value of the bond at a YTM of 10%, which is simply going to be 5 into present value annuity factor at 10% for 10 years plus 100 into present value factor at 10% plus 100 into present value factor at 10% for 10 years. So just give me the value of the bond at 10%, guys. Tell me what's the value of the bond. If I take the YTM as suppose 10%, if the YTM is 10%, what's the value of the bond? It's 1 divided by 1 divided by 1.5, 2, 3, 4, 5, 6, 7, 10. So it's 100 into 0.3855, and this is 5 into 6.14. Then the bond trades at a premium. Now, since this bond is trading at a premium, the YTM is definitely going to be less than 5% or less than the coupon rate. YTM is going to be less than the coupon rate. So let's try to compute value of bond at YTM of 3%. So it's going to be 5 rupee coupon into present value annuity factor at 3% for 10 years plus 100 into present value factor at 3% for 10 years. So just add them and see what's the bond value coming out to be at a YTM of 3%. Give me the value of the bond at a YTM of 3%, guys. Give me the value of the bond at a YTM of 3%. How much is the bond value at a YTM of 3%? Divided by. So this is going to be 5 into 0.744. That 5 into 0.7441. That is 3.720. What will be the value of bond? If YTM is fund the same, it's going to be 100. Right? You want a value where you want the yield where the value of the bond is 107. So you know how to do that interpolation, right? Carry out the interpolation, give me the value of x. Okay, fine. Then let me help you with that. So we'll say rate and value. So when the rate was 5%, value is 100, and when the rate was 3%, value is 117.06. So what is the change that we are looking at? How much is the change? What is the change that we are observing? Rate has reduced by 2%. So the value increased by 17.06, right? When the rate reduces by 2%, the value increases by 17.06 rupees. But did we want to change it to 17.06? No. How much is the change we wanted in the bond value? From 100, we wanted it to make it to 7, right? 107. So we just wanted a change to be of 7 rupee, right? So if 7 rupee is the change that we wanted, what is the percentage change? Percentage change for change in value of 7, and it will be 7 into 2% divided by 17.06. So that's 7 into 2 divided by 17.06. 7 into 2 divided by 17.06. That's what, 0.82, right? So in fact, this was a minus sign. So we want a minus 0.82 percentage change. So what will be the YTM? YTM will be 5% minus 0.82%. It means instead of subtracting 2%, you should subtract just 0.82%. So that's simply 5 minus 0.82, which is 4.18% is the YTM value. Got it? Are we good, everyone? Yes. So this is how you compute the YTM of the bond. Now let us go for understanding the risk that we face in a bond. Investment in a bond, is it risk-free? Is it risk-free investment in a bond? Yes or no? Do we have any risk when it comes to investment in bond? So risk of investment in bonds, can we say the risk of investment in bond is zero? Do we say that risk of investment in bond is zero? No. We can say it is not zero. So what sort of risk do we face? First and foremost, the risk which comes to our mind is the default risk, right? So default risk is possible in non-government bonds. Generally, governments don't default, so we say uh, government bonds are risk-free, whereas we can definitely say, sir, apart from government bonds, if you have any other bond, there is obviously a possibility of default. So there is this default risk. So risk of investment in bonds, it is not zero. In fact, it's a default risk, which is possible risk in the non-government bonds. So risk of investment in bonds is not zero. There is a prominent risk called as a default risk, and that's going to happen in non-government bonds. But there is a risk which is there even in government bonds. Right? So there is a risk which is there even in the government bond, and that is called as a interest rate risk. And this interest rate risk is there in all tops of, or all types of bonds. Interest rate risk is going to happen in all bonds, right? Interest rate risk is going to happen in all bonds. Now, what is this interest rate risk? This interest rate risk simply means change in bond value. So interest rate risk is the change in bond value due to change in interest rates. So as the interest rates change, what is the impact on the bond value? That is what we are essentially talking of. Okay. So change in bond value due to change in the interest rates. That's your interest rate risk. Okay. Change in bond value due to change in the interest rate. That's your change in the bond value due to the interest rate change. That's your interest rate risk. Now let's try to understand what is this. So when we have, let's say, uh, a bond with a face value of 1,000, coupon of 100, term is 3 years. Okay. And if the YTM is, let's say, 12%. So if the YTM is 12%, can you tell me what is the bond value? If the YTM is 12%, what is the bond value? Bond value is simply going to be 100 coupon multiplied by present value annuity factor at 12%, and to that you're going to add 1000 into present value factor at 12% for 3 years. Yes. What is the bond value at a YTM of 12%? How much is the bond value at a YTM of 12%, guys? Tell me. It's what? 951.960. Now, suppose if YTM increases, YTM increases from 12% to now 13%. Do you expect the bond value to be remaining same? Do you expect the bond value to be remaining same? No. So what is the new bond value now? When YTM changes to 13%, what is the new bond value? What's the new bond value? What's the new bond value is? Calculate it. You can simply get it as 100 into present value annuity factor at 13% for 3 years plus 1000 into present value factor at 13% for 3 years. Hmm. Give me the bond value at 13%. Okay. What's the bond value at a YTM of 13%, guys? So it will be 1 divided by 1.13. 1, 2, 3 into 1000 plus. Yeah, that's 929.22 or 929.17. That's okay. So what we observe is as the YTM increases, bond value is going to decrease. So this is exactly the risk that we are talking of. So when we say interest rate risk is that risk of loss risk of loss in bond value due to rise in interest rates. So risk of loss in the bond value due to rise in the interest rates. That's your what do you say, bond value, or that's the risk of loss in bond value due to rise in the interest rates. That is your interest rate risk. So how do we measure this interest rate risk? Okay. So this interest rate risk is, essentially measured by a term called as the modified duration. So let us try to compute something called as the Macaulay duration and modified duration when we are trying to understand what is the change or what's the risk that we are facing. Okay, so let us take a bond with a face value of 1,000, against which we are getting a coupon of, let's say, 90 rupees. And then we have like face value of 1,000, coupon of 90. Um, Term is 5 years. And let's say the current YTM is 10%. So assume that the current YTM is, let's say, 10%. We can definitely calculate uh, the bond value, but I don't want to calculate that by shortcut method. Rather, I want you to calculate this by a long cut method, because we'll be using that further for calculation of the Macaulay duration and modified duration. Now, what is that? We'll come to know. So we have, let's say, years, cash flows. So in year 1, 2, 3, 4, 5. So in total, we have got 5 years. So in these 5 years, you're going to get a coupon of 90 every year. And the final year, you have 1,090. We write down the present value factors at the YTM numbers. So present value factor at 10%, and then we take the PV. So present value factor at 10% is going to be 1 divided by 1.1, which is 0.9091. Then it is 0.8264, 0.7513, 0.6830, and 0.6209. Then we take the multiplication of both, that 19 to 0.9091, which is 81.819, 19 to 0.8264, which is 74.376. Then you have 19 to 0.7513, which is 67.617. 19 to 0.6830, that's 61.470. And 1090 into 0.6209, which is 676.781. And then we just take a total of it, 81.819 plus 74.376 plus 67.617 plus 61.470 plus 6676.781. So we have the answer as 962.063. And this is essentially the value of the bond. But our area of concern, our area of interest right now, it's not to get the value of the bond, but we want to take it further with some other aspects of discussion. Okay, so before we go to measurement of that risk of or interest rate risk of that bond, let's try to understand something called as a weighted average bond or weighted average of numbers. It's called as some sort of duration. Okay. But that duration, let me name it itself. It's called as the Macaulay duration. Macaulay duration, or in short, which we call it as a MACD. Okay, it's not that MACD means, it's not that talking of McDonald's. We are talking of Macaulay duration. So Macaulay duration is simply the weighted average time period. So weighted average time period of investment in bond. So if I ask you, how much money are you going to invest if you want to acquire this bond? Of course, 962.06. But if I ask you, for what time period is this 962.06 invested? What is the time period for which this 962.06 is invested? What will be your answer? For how many years have you invested this 962? For how many years have you invested this 962? Can we really say 5 years? Is that entire 962 invested for the full period of 5 years? Is it invested for a full period of 5 years? The 962 point, 02, is it invested fully for 5 years? Is it fully invested for 5 years? No. You are going to receive some sort of cash flows, right? You can see out of 962.063, 81.819 in present value terms is actually received in 1 year. So this entire 962, we can't be saying that this entire 962 is invested for 5 years, because out of 962, we say 81.819 is invested for 1 year, 74.376 is invested for 2 years, same way 61.47 is invested for 4 years, and 676, this is the largest amount, which is staying invested for 5 years. Right? So when I want to know what is the weighted average time period of investment, I can't be simply looking at these total of, I can't be saying that this entire amount is blocked for 5 years. I will definitely say this amount is not fully blocked for 5 years. In fact, it is blocked for a smaller period, smaller time periods. Okay, so it's a block for a smaller time period. So to get the weighted average time period, you know the formula. We know the weighted average formula is summation of weights into x upon summation of weights. So Macaulay duration, we have summation of weights into x upon summation of weights. Okay. So summation of weights into x upon summation of weights. Now, what is x and what is weight over here? What is x and what is weights? In this table, which column is representing x and which column is representing weights? Yeah. Well, x is the number of years and weights is the present value terms. So what we do is simply years, which is number of years, n into PV. We just take n into PV as a numerator part, which is summation of n into PV, and then denominator will be summation of PV, or let me call it like this, summation of PV into n. Okay, so summation of PV into n. Let's multiply and get the values. Present value into n, so that's 81.819 into 1 is 81.819. Then you have 74.376 into 2, which is 148.75. Then you have 67.617 into 3, which is 202.85. And you have 61.470 into 4. That's 245.88. Finally, 676.781 into 5, which is 3383.91. So take a total of all of them, which will give us a numerator value for the weighted average term, which is 81.819 plus 148.75 plus 202.85 plus 245.88 plus 3383.91. This is 4063.21. So Macaulay duration, numerator is 4063.21 upon 962. So this is divided by 962.063. So the Macaulay duration is 962.063. This is coming out to be 4.22. So on an average, we say that the money is blocked for 4.22 years and not for the full 5 years. Your money is not invested fully for 5 years. It is blocked for a period of 4.22 years or approximately 4.22 years. That's your Macaulay duration, right? So Macaulay duration is always going to be measured in years. Macaulay duration is going to be measured in number of years, guys. Okay. So Macaulay duration, it is 4.22 years. Now, this is not what is a concern for us. For us, what is relevant or what's really important is not Macaulay duration, but modified duration. Let's first calculate it and then look at its interpretation. Modified duration. Modified duration is Macaulay duration divided by 1 plus YTM. So Macaulay duration is what? 4.22 divided by 1 plus YTM, which is 1 point, YTM is 10%, so 1.1. Yeah, 4.22 divided by 1.1. This is 3.84, and we call it as times. 3.84 times. Okay, 3.84 times. What does this really signify? What is this term, really signifying? 3.84 times. What is this term signifying? This simply means for 1% change in YTM, there will be 3.84% change in the bond value. Or to put it other way around, if interest rates, that is your YTM, increases by 1%, bond value will reduce by 3.84%. The bond value is going to reduce by 3.84%. Like in our case, when the YTM was 10%, we got the value as 962.063. Okay. So for this same term now, let's just try to evaluate this concept. So when YTM was 10%, we got the bond value as 962.063. 962.063. Now let us just try to test this particular proposition of modified duration for a YTM change of 1%. So let us say if your YTM rises to 11%, what will be the bond value is? Now you can compute this bond value in a shortcut way. So this bond value will be calculated as what? 90 into present value annuity factor at 10%. 10% for 5 years plus 1000 into present value factor at 10% for 5 years. Okay. Give me the bond value at 11% YTM. What is the bond value at a YTM of 11%, everyone? So at a YTM of 11%, what's the bond value? Here this is 1 divided by 1.11. 1, 2, 3, 4, 5. into 90 plus 1 divided by 1.11. Yeah, what's the value? I think there is some 1.11. 1, 2, 3, 4, 5 into 1000 and plus we have 1 divided by 1.11. 1, 2, 3, 4, 5, 50 into 90 and plus. Yeah, this is coming out to be 926.08. This is the bond value. So if I ask you, what is the percentage change in bond value? Just check. The bond value is reduced to 926.08 from 962.063. So with a starting value of 962.063, what is this coming out to be? 926.08 minus 962.063 divided by 962.063. So the reduction that we see, how much is it? 3.74%. And what we initially got as a modified duration of 3.84. So approximately it is showing us on the similar lines, 3.74, and this is what, 3.84%. Approximately it is the same, but there is still some difference. There is still some difference in the value of the bond when we use the modified duration. So it's not actually able to capture the complete change that we observe in the bond value. And can anyone tell me what's the reason for that? What's the reason for that modified duration being not in a position to capture the complete change in the bond value that we observe? Yep. What's the reason? Yeah. What's the reason? Well, the reason lies in the concept of convexity, right? So let me just show you some diagram for the easy understanding of this term of convexity. So we can say that we know that the bond value is inversely related to the YTM. So if you place YTM on the x-axis and the bond value on y-axis, we don't get a straight line like this, right? So in fact, the bond value is not a straight line, it's a curve like this, right? So initially, when we were having the YTM of 10%, let's say for a YTM of 10%, this was the bond value. So when YTM was 10%, the bond value was 962.063, right? Now, when you are increasing the YTM to, let's say, 11% now, so YTM has increased by 1%, and what we see is that bond value is actually going to fall, and the actual bond value that we observe is 926.08. Okay, so bond value is reducing like this. Okay, so this is the actual change. But if you just look at uh, the modified duration, this is essentially a tangent line which is formed on your YTM. So at your YTM, you can actually have a tangent line like this. So this is your essentially point of tangency. Okay. So this is what is your uh, point of tangency, and this is essentially denoting your modified duration line. Okay. This is your modified duration line. So if we just look at what is happening when we say that the YTM reduces from 10% to 11%. Okay. So 10% to 11%, if you observe, uh, the change that you see, where the actual change that we are observing over here is 3.74%, which is captured over here, 3.74%. But if you look at what's happening with this tangent line, or when we are just referring to uh, the modified duration, what we essentially see is, or what this modified duration was telling us, is that the change is going to be 3.84%. And that's exactly what you are observing over here, that this particular change is 3.84%. So the extra change that we have over here, or extra change that the modified duration is telling us, the extra change that the modified duration is telling us, that is because of the convexity. Okay. So this particular line, this is your convexity adjustment. Why do we have this convexity adjustment? For a simple reason. The relation over here is actual curve, but when we blindly use the modified duration, we are simply looking at only the change in the form of a straight line. So when you're looking at a straight line, of course, the change is not going to be exactly same as the curve, because curve is actually getting slowed down, but your straight line is falling in a similar fashion. So the difference that we observe, this one is called as the convexity adjustment. Okay. So this convexity adjustment is essentially going to be there to capture the convexity is going to be there to capture the change that's going to be there due to the curvature effect. Okay. So convexity effect is going to be 1 divided by which is price or the bond value. The formula that we generally have, this is price, that is 1 divided by price into 1 plus the YTM square. Okay, and then multiply it by summation of PV into T into T plus 1, or N, you can say, instead of T, you can also call it as N also. So PV into N into N plus 1. So in our calculation, to calculate the convexity, I'll have to do some more columns, PV into N plus 1. You'll get this total, right? You'll get this total, and then we're going to substitute in this, and then divide it by the uh, bond value into 1 plus YTM square. Okay, so this is your convexity. Now remember the modified duration that we did. Modified duration, this is essentially your derivative of bond value with respect to YTM. So this is your derivative of bond value with respect to YTM. So this is your first order derivative. first order derivative of bond value with respect to YTM, because you're looking at what is the change in the bond value with respect to change in YTM. On the other hand, convexity is the d square BV upon dyTm square, which is second order derivative. So it is second order derivative of bond value with respect to YTM. So how do we calculate the actual change in the bond value? So change in bond value due to change in YTM will be initially computed as change in YTM multiplied by Macaulay duration. This is going to provide insufficient number for capturing the entire change, right? So this change is to be compensated by the convexity adjustment, and that convexity adjustment is half into convexity into change in YTM square. Okay, so whenever there is a change, so we see that there is a curvature over here. So initially you have this straight line, then you try to bend it a bit so that it becomes closer to the actual bond curve, and that actual bond curve is essentially going to be captured to some extent, to a great extent, by this convexity adjustment. Okay, so if you just want to check with our number, you can definitely calculate these numbers and substitute in this, and you'll be able to see that the difference which we initially observed, 3.74 and 3.84, so 0.10, 0.1 times the difference which we saw, that was due to that convexity. And when you fit in that convexity adjustment, it's going to be completely matching. Okay, so that is your Macaulay duration, modified duration, and convexity. And with this, I think we have covered the bond market revision, except one thing which is also called as the bond immunization. Okay, so as we said, modified duration, it was helpful for us to understand the sensitivity of bond value with respect to the YTM. Macaulay duration was the weighted average. This Macaulay duration is going to be used to create a bond which is create a portfolio of bond which is immune to any changes in interest rate. So if at all there is a change in interest rate, you can actually create a portfolio of bond which will not get affected. The value of the bond, value of that portfolio is not going to get affected by the change in the YTM. And that can be simply done by creating a portfolio which has got the Macaulay duration equal to your target duration. Okay, so we'll discuss about that bond immunization and the security, I mean the equity valuation part in our next session, which we have it on Saturday. Okay, so with that, we'll be completing our today's session. If you have any queries, I'm happy to address that. Any queries, everyone? No queries? Okay.
Thank you, Jagbantu sir. Am I audible, sir?
Yeah, you're audible, sir.
Okay. So your session was very interactive, and in fact, the topic or the both topic, that is mutual fund and security valuation, are the pulse of the today's time. Because see, in today's time, the mutual fund has become very important source for the investment for the small investor. And when we analyze the mutual fund, there are different types of categories of mutual fund as per investors' own risk appetite and as per their own preferences. Recently, in February 2026, there is a new kind of a mutual fund concept has been coined, that is called life cycle funds. So this fund is mainly recommended for the, now it is in the process, because draft process, draft prospectus has been filed by Jeredwa Mutual Fund, etc. Somewhat one or two mutual funds, etc. So the purpose of this fund is that it is a long-term fund, and initially they will start investing according to the age, because age and the risk appetite, it matters a lot. In the young age, a person may have a higher risk appetite, and that's why they can go for the equity. Whereas the moment the age there passes, and when they start coming to near to retirement age, say they start preferring a safer income. So accordingly, in this same manner, in the initial, when anyone will invest, their corpus amount will be invested in the equity. The moment as the time passes, they will start diverting from equity to the debt investment. So by this, accordingly, they will have a both gains. So this kind of a different innovations normally takes place in the mutual fund, even sectoral funds. There are some other kinds of a fund as well. Now, so far as the security valuation is concerned, it is another very important topic, because nowadays many chartered accountants are in the field of valuation, and they are doing the practice of valuation. Valuer, they are valuers. So security valuation is also one of the very important topic, and in this the bond is one of the very important topics nowadays, because in India, even the government is also promoting the bond market. They are also interested. They are saying that we should come out with the because in India still bond market in its nascent stage, because of course government bonds are and treasury bonds are major part of this bond market, but government is also asking the private corporates to issue more and more bonds. The problem with the bond is that, like unlike the equity, they don't have that much of liquidity, because bond have a duration. So accordingly, the government is trying to develop a secondary market. Okay, and even there is some, I think there are some negotiation are going on bond, and that is inclusion of the bond, Indian government bond into the international benchmark bond market index as well. So all these are very important concept, and especially when we talk about this Macaulay duration, because Macaulay duration is basically the indicator of the volatility of the bonds, whereas beta is related to equity market. The correspondingly indicator of the risk, we can say, is this is our modified duration. So, and Jagbandhu sir has very beautifully explained how it is a first derivation and second level derivation. So I hope student, it must be very clear to you. Jagbandhu sir, just write down our email ID as well as phone number. Student, I think your queries are all resolved, but still if you have any queries, so these are our email, sfm-final@icai.in, and our contact number is 0120-3045-956. Okay, so student, you can call me at this number as well. So student, I hope and I request you to please revise whatever we have discussed in the previous two classes. So when in the next class, when Jagbandhu sir will be there, you can even ask their query, and in between you can also send us your query. So till then, all the best to you for the preparation. And Jagbandhu sir, thank you once again for sparing your precious time and enlightening the student on this topic. Thank you very much. Have a nice day. हाँ, session over.